Well, good morning, everyone in the chamber and watching this live stream from home. This is a workshop to discuss the annual plan for 2025 and 2026. This is the second workshop that we've had, and I would expect that there will be a third. Joining us on video, we have Mayor Clark, who will have a few words to say. I've got no doubt in a few minutes. So this is the second workshop. The first workshop, you'll recall, we talked particularly about the process of developing the annual plan and the fact that we don't start from a blank sheet of paper. We start from the long-term plan, which was finalised earlier last year, and we look at whether there are any external environmental or internal conditions that might have changed, which would force us to, look again at the long-term plan. But again, we don't start from a clean sheet of paper. A piece of information which Rhiannon gave us at that meeting was that it looked as though the costs that we had built into the long-term plan had increased, and that in fact the implication of that for rates would be that rates might push higher than the 8% that we have in our LTP. We have a presentation from the CFO in a few minutes, which unfortunately will show that that is so, and that in fact it will push significantly above the number that we had in the LTP unless we take action to mitigate that. So remember that this is a workshop, so we'll be making no decisions. Rather, we should be debating the issues, and management will, I guess, try to correlate what we have said and bring it back to us in a form that will allow us to approve it at some stage at a council meeting. But to begin with, Rhiannon is going to introduce, I guess, particularly the process that we're in, Rhiannon, and just where we sit with it.
Yes. Kia ora, councillors. So in the slide deck that's in your packs, we'll work through the first portion. I've just got a few slides that I'll whip through on the process before Patricia will talk to some of those numbers that the Deputy Mayor suggested, or mentioned rather. You'll note in the back of the slide deck that our background slides, we are not planning to present those. Those are for your information. So the purpose of the workshop today, we'll quickly review the process and the timelines. We'll go over some of those required changes that are being driven both by the economic environment and regulatory policy changes coming from central government, some budget changes that the executive leadership team need to bring forward, and then in the second half of the meeting discuss some proposed saving options for you to consider. So really, Tom, you've covered some of this, but there's just a reminder that what the annual plan is required to do is describe variances to the long-term plan. That's variances in terms of the services, in terms of the capital program, in terms of expected rates and other revenue forecast changes. So that's some of what we will go over today. You are obviously the representatives of the community in making those decisions and thinking about what is different to the long-term plan that we consulted on considerably. Through the annual plan, we are required to consult where there are significant changes, either to projects, levels of rating, or to levels of service, and we discussed some of that in the workshop at the end of last year. So this workshop is not covering those consultation issues, it is covering the budget items. Briefly, just because we are in a little bit of a different environment because of the water reform program, just a reminder on the process. We are likely, because of the water service delivery plan, to need to amend the long-term plan at some point next financial year. If we were to make significant changes to levels of service now, that could also trigger an LTP amendment. The water service delivery or rather the Local Water Done Well legislation changes that the government's taken through. They've noted that we will consult now on our water service delivery plan, which we'll do alongside the annual plan. We won't need to consult again on the LTP amendment, but we will need to audit if we amend the LTP, which is highly likely. We have just received additional audit costs coming through, which Risk and Assurance will receive from the last LTP just done, so it's not an insignificant sum of funding. A reminder on the required changes for water services. We do need to move towards 100% depreciation on all services by within 2 years, so the leadership team are recommending a step change to consider now as part of this annual plan. So as a reminder, in year 2 of the LTP, we are currently at 87% funding for depreciation. That's 100% for water, 80% for stormwater, and 80% for sewerage. So you've got an option today to consider to moving 100/90/90 to bring up that increase over time. The other big item that we need to address and look at now is ring fencing of water services. So that is around making sure, as you've had in depth through those infrastructure meetings around what it will mean for the new water delivery, that that service is considered separately and in entirety, and that means treating the overheads, the internal overheads differently. So again, Patricia and Michael bringing forward options around that now. A reminder on some of the messages that have come down from central government, which I know will be in your minds, around how we're looking at budgeting. We're expecting at some point, probably next year, that the 4 wellbeings coming into the next LTP will be coming out. I'm quoting from government communication earlier this month around no grand projects, hence the little inverted commas mark. Focus on user pays. You know that we have been focused over the last 3 years on bringing our fees and charges closer into alignment with our revenue and finance policy. That is not a core focus today in terms of the items that we're bringing forward, but the fees and charges schedule will be coming up to council at the end of February, and there are some of those increases included there. So that is just really continuing on the same pathway that we have been on for a number of years, so that we have a greater proportion coming from user pays. They did signal reducing some legislative requirements that is creating a drag on local government. One of the examples given was advertising notices. The governance team are actually pretty efficient in terms of how they advertise formal meetings, but there would be a small portion to be saved there, and we have brought that into the budget. Audit costs are obviously a lot more significant, but we're not, since those costs are rising year on year, we're not sure in reality whether those savings or how they're going to be realised, so we haven't attempted to model that. Obviously they've been discussing regional deals and funding around amalgamation proposals. We've talked about Three Waters ring fencing, and the final point just to make is that there is some early signalling around insurance, which we'll discuss today, and reduced coverage coming from central government. So insurance and how we cover that risk. The New Zealand market is being risk rated differently, and Patricia will be talking about that through this workshop as well. Well, I think this is my last slide before Patricia talks about what's driving those rates increases for years 2. So this is really just about providing some context of where Invercargill district sits in relation to the national context. So you can see our average residential rates. This is via the Taxpayers Union comparison, so I think that, and Patricia, you can correct me if I'm wrong, I think this is last financial year's figures.
Yes,
That's
it's
correct.
23-24.
23-24, so as a comparison, we're sitting slightly behind the national average. You can see the same is true for the average power bill within the region. You can see the power bill is just slightly behind, sitting where rates are sitting. Our GDP per capita, that's the Southern figure because the Invercargill one hasn't yet been released. So GDP per capita in the city sits slightly behind the district, but you can see we compare well across the country. Our average household income is slightly lower, but also our house prices are considerably lower as well. Our weekly rents have been going up over time, and in terms of that deprivation index, as you're aware, there are areas in the city where there are high levels of deprivation in terms of the rest of the country. So just comparison for that just national conversation that's going on at the moment. So that's my part.
Okay, so thanks for setting that context, Rhiannon. So what we're going to do today is look at the drivers of increase in cost, and then we will look at how we can mitigate that. The first part, which is what are the things which are driving costs up unexpectedly, if I can put it like that, more than we had included in the plan. The first part we're going to do in public session. The second part, which is how do we mitigate that, how do we try to avoid those costs or else reduce costs elsewhere, we'll do in public excluded. And the reason for going into public excluded is because any discussion about reducing costs inevitably brings into question things like commercial contracts and so forth, where it's appropriate to be doing that in private discussion. So the meeting will have two parts. Now, just before we go into that then, Nobby, I know the Mayor, I know that you wish to make some opening comments. Do you wish to do that now?
Yeah, that'd be great, Tom. Thank you for that. I guess just wanted to create some issues around also the environment that's changed for us in the last year or two. Certainly the messaging we're getting from government is around no major projects, and also around capping of rates. And so if we're considering between 8 and 10 or 10.5%, that will push back against the messaging that comes from government that it should be closer to the CPI cost. It also seems to me that we tend to have a mentality in council, and it's not unique to this council, in most councils, that we just look at cost plus. And cost plus basically means we just take whatever we spent last year and we add to it, because we've got factors that are pushing some of those costs up, where I think it would be helpful this year in particular, given the cost of living impacts on ratepayers, that we also consider looking at how we can drive some of those historical costs down, and pleased to do that in public excluded. So I think that's an important factor. It would be an interesting exercise if we didn't have the workshops that we're currently having, and our framework was different, whereby the ratepayers decided how much they wanted to contribute more to the rate take of the city, and what would happen if they came in and said 2, 3, 4, 5%, or what it was going to be, given that it compounds. How would we deal with that, and what would the management approach be, that they would have a shrinking income level? So I think that's important as we go forward to be considering some of those things. So thanks for that.
Okay, thank you. So as we move into the presentation from Chief Financial Officer and the CEO, what I'd like us to do is in asking questions, and we'll go slide by slide actually, and I'll allow questions slide by slide, but please make them questions of clarification. Please make them questions of clarification rather than questions about how do we mitigate that, because we'll get into that in the second part of the meeting. So the first part of this meeting should be so that we understand better what the cost drivers are, and we get the opportunity to question that. So before we move off the context, I know there are a couple of people who do want to ask questions about the context, I hope. Rangi, I'll take your question first.
Thank you, Chair. Look, my question's around your reasoning for council to go into public excluded, and I would like to lodge an objection to that, because I don't see any commercial contracts up for discussion, so I don't see the requirement for us to go into PE at all. So I'd like
your
to...
objection's noted. I mean, I would just make the point this is a workshop rather than a council meeting. the testing into publicly excluded is different. I think inevitably during that second part of the workshop, we will discuss matters which are better to be discussed not in public at this stage. That's my view. Leslie, you had a question?
It's not so much a question as a statement as the Chair of Finance, that when we talk about cost of living index, I just want everybody to be quite clear that the cost of living index we are talking about as councils is not the cost of living index that measures the cost of bread, groceries, fruit, vegetables, whatever. We are talking about an entirely different bundle of goods that makes up the local government cost index. That is quite a different percentage figure than what people think of as the ordinary cost of living index. And I want that context to be quite clear in the public part of the meeting, that we are not talking about bread and milk. We are talking about a different bundle of goods entirely.
You might want to comment on that, either of you. Do we actually have a number for, I mean, there is no published number for what Leslie's describing, is there? I mean, we know that that's true, what Leslie just said, but I don't think you can look up New Zealand statistics or something and get that number from that. So
there is actually a index that is actually provided by Burl for local government, which is the Local Government Cost Index. And I will go into that in more detail as I go through the slides.
Thank you.
Okay, thank you. Okay, well, moving on in that case, I think we have you next, Patricia, talking about the drivers of the increase in cost to the annual plan next year.
So where we're going to start is looking at the drivers of the increase above the 8.5%, which was agreed in the long-term plan 6 months ago, at the end of June, when we agreed that year 2 would have an 8.5% rates increase. So in the nearly 7 months since, what we've seen, and probably the biggest, there's a couple of big ones, and they start at the top. So we'll look at inflation. So there is what the media say about inflation, and they've just released the December 24 inflation for the CPI, being the Consumer Price Index. It stayed at 2.2% for the 12 months. Now that Consumer Price Index is set up of a basket of goods which consumers and households would purchase. So I think it's approximately 19% of that basket is food. Then 30% of it is housing and housing utilities. So that covers council rates, but in council's rent, power, internet, and then the next biggest one is transport at 13% of the basket, and then recreation and culture at 10%. And so that basket includes things that council would not buy. Transport is similar, but it's using a totally different set of indexes. The local government cost index is what most councils will use. Councils as a collective engage Burl as a consultancy to provide that on an annual basis. Burl use the number of the different indices provided by Stats New Zealand. So they produce more than just the Consumer Goods Index. If anybody has delved into the Stats website, it is a myriad of indices of different costs for different people. So we use the Capital Goods Price Index and aspects of that, which is a basket, different baskets of goods for capital, as well as the Producer Price Index. And those are things like we buy, like pipes. There is a Pipelines Index. There's also an Earth Moving Index. So what Burl do is take those indices and create a basket of goods that councils buy. What they have done, and they did it for the LTP, is they split that basket for councils to the basket for Three Waters and the basket for non-Three Waters local government, because recognising that actually the price and what goes into a Three Waters activity is much more pipelines and construction than a non-Three Waters. So when we look at that now, because they have redone it for the 25-26 financial year, what they're saying is that the inflation that they're predicting for that year is 3% for non-Three Waters and 4.4% for Three Waters activities. So if we were to blend it back together to what we are sitting in our LTP, that comes up at 3.2%. What we had in the LTP was a 2.2% inflation increase. So that's another 1% on top of a cost that we hadn't budgeted for.
Does that, sorry for interrupting you, does that mean then that given that is the overall cost inflation index that's been quoted for local government, which is, as you say, 3.2 or 3 or something like that, that ought to be our target and not the 2.1 or 2.2 that we spoke about before?
And that is the target for us. And if we look at some of the benchmarks that we set during the LTP, our rates increase target was using the local government cost index, as our rates would be the local government cost index plus the limit on our rates would be that as our base plus a margin. With Three Waters coming out, it shows the difference in that, and that is significantly higher just because what goes into those products. There is another indice that we've also been using for some of our assets, which is the price of bitumen. It sits in a different indice by NZTA, but as you can appreciate, that itself has an important cost impact in our roads, and that doesn't necessarily follow with that as well.
I mean, it's an important point that Leslie raised first, and you've clarified in terms of what the magnitude of that is. I mean, it's a little bit moot, actually, because we're not talking about increases of 3% of what we're talking about increases that you're going to show that's 3 or 4 times as much as that. So whether it's 2.5 or 3 or 3.5, that is not actually what we're looking at in terms of proposed rates increase.
But as we build through the components, this is a big part of it. When we actually built up that 8.5% last year, the impact of inflation at that lower number meant 3.73% of that rates increase was to counter the effects of inflation.
So I think we should let you work through your slides, actually, Tricia.
So the next major change that we've seen since we've done the long-term plan is insurance. And this is predominantly the market changes in New Zealand in relation to public liability and professional indemnity insurance for councils. We've seen probably less increase in our material damage cover, if that's for our buildings. But it's in those what I would call indemnity insurances. We had a position where, based on New Zealand's statutory position, insurers do not like insuring councils because our risk is seen too high, because we will always be there if there's a failure within the building sector. Councils will have consented if the works were consented, so they, because the risk is high for them, they price it high. And it was resulted in that we actually had to go to London insurers to get cover for our public liability and our professional indemnity. And those two pieces together are over $1 million in premium. And it was a significant increase that we had. So we're looking at that. We have to now rate for that increase because we didn't know about it when we did the LTP. So we now have to adjust the rates for that. Now, as Rhiannon alluded to, the regulatory requirements, so this is predominantly around the Three Waters and going to the ring fencing. It's my recommendation that we look at moving to the ring fencing in this annual plan. We will be using approximate things for corporate overhead because we will need the 12 months to work out what the appropriate drive is and to get that more accurate as possible. But there's also a lot of costs, and we'll go through them, they're in later slides as well, that come with those changes. There's the regulation, and remembering that water is essentially moving to a user pays model. So there's self-regulation. We will have to do a lot of setups internally to change, to be able to meet what the legislation is suggesting, or the proposed legislation is suggesting. So that probably covers that aspect off. Increased capital delivery. The long-term plan was a step change in our proposed capital delivery. Up until the long-term plan, our maximum capital delivery in a year was 50 million. We stepped it up to 80 million. And some years actually even top out higher than that. With that comes additional borrowing. So as we were going through, we've had we've had to factor that in. Our borrowing rates is probably the only thing that doesn't change. Our assumptions in relation to the long-term plan on borrowing have stayed the same in relation to interest rates, but that increased capital delivery has put pressures on other aspects as well. And then the service offering that we agreed by council. So it's costing us more, as I've said, to deliver them. And really in the long-term plan, if you recall what the purpose of the long-term plan is, that's our agreement with the community about what service we will provide them and how we deliver them. So we'd have to hold those pretty much the same coming into an annual plan. As Rhiannon's already said, a significant change in that level of service will trigger an amended LTP, which triggers the rates, the need for audit to come back in and re-audit that. So rather than looking at a year, you redo 9 years. So it's not just, to do an amended LTP is a significant workload on staff and on yourselves, because we'd have to go back through all the various processes again. So that's what I had for that slide, if there's any questions.
So I said that we would take questions slide by slide, and I know that Grant has one at the moment.
Yeah, thanks, Chair. Just a question on that maximum capital. Patricia, I think you said 50 million. What's the actual capital expenditure been in the last 4 years?
That was the actual fit that we've taught. The maximum year has been just over 50, about 51 or 52 million.
Yeah, but the other 3 years, what's the full?
50, and then they were down into 30s. 50 for 3 years, and then it was a 20 or 30 before that.
Okay, and so that's including all infrastructure spending, so
Yes,
roads
across the whole organisation.
yeah, plus projects.
Yes.
Oh, thank you.
Okay, keep going.
Thank you, Chair. Falls on myself to give you the build-up of from the LTP through to current state before we go into the discussions later on in relation to, well, what's next. I'll hand back over to Patricia after I've gone through the slide to talk a little bit about each one more in detail, specifically around one of the lines, which is quite a combination line. But I wanted to start by highlighting that the LTP Year 2 rates was 8.5. Council had made a decision in relation to setting those that there was, we were going to be smoothing. It was part of the financial strategy, a smoothing rates impact over the first 3 years, and then we would be having a small increase in the latter years to recover that smoothing. I have to put that in there to show that that is the impact in the current year, to say that take that smoothing off, and we will need to have discussions about reconfirming that strategy in relation to in the public exclude component as we work through those aspects. So that then puts you back, what was the true increase in Year 2? That was the 10.93 that you see above you there. The other aspects, what Patricia's just highlighted, but she's got a few slides coming up which will talk more in detail in relation to these, is the inflation component. I think she's actually talked to the slide that she's got coming up anyway, but the net in relation to that is a 1%, roughly a 1% impact in relation to the starting position That's a 1% increase on those cost bases. The other aspect we've got in there is insurance. Patricia's highlighted those components. The insurance unmitigated is a 1.5% increase. So you can see I'm starting to build a picture of going upwards. As Patricia highlighted, the interest position has had next to no impact. I would say the reason you've got a slight impact is in relation to the loss from the previous year coming through and the impact of that and borrowing costs associated to that. It is minor, but it is a 0.1 difference. The other items, which Patricia, as I said, will discuss shortly, these are impacts on it, on the percentage, both favourable and unfavourable. The capital program delivery component would highlight if you don't deliver all of that capital program that we had indicated, there will be a negative impact the next year in relation to those, and that will be shown when Patricia gets to it. That's around 1.6 off the opening position. That gets us to a position, based on all of those impacts, of 11.9. Now I just want to touch base on what Patricia raised in relation to the three waters and regulatory requirements. This is regardless of Council's decision in relation to options, because all of the options in relation to three waters require us to be heading towards a baseline year in 25-26. So that will be used regardless of which direction Council take in relation to our baseline position. If you put a baseline position as we currently have, we would have some implications in relation to regulatory compliance. Those areas are, in relation to ring fencing, you can see there's a 0% impact in relation to Council, but that's splitting it between the three waters services and the Council services. So it's a shifting of our costs to make sure we are correctly allocating cost between the different services. I'll remind us we have a corporate services activity under our long-term plan. That is the one that will receive a uplift in relation to that, as in it will receive the revenue associated to that. The other one that highlighted, there will be a need to do implementation as we do that transition. In relation to ring fencing, we will need to look at our systems and actually make sure that they are ring fenced for a particular entity. It's not something you have from a service perspective. You actually need to have revenue calculations and everything separate to be compliant with a separate entity component or view of ring fencing. We also have been indicated there will be an amendment in relation to the audit, which Rhiannon highlighted earlier on. We're indicating that that is part of the regulatory changes and that is part of the three water services. We will need to look at the allocation of that, but at the moment we believe that it is a three water alone impact and would not be required if it were not for the regulatory changes of three waters. So therefore we've apportioned that cost across to three waters. You've also been briefly indicated what the recommendation from staff is in relation to the move towards depreciation. Going forward under the regulatory requirements, three waters will need to be 100% funded on depreciation line. Historically in public sector we used that and focused in on our renewals being the funding stream. In this case we're recommending you take a step towards, not the full step, so when you hit the next year you can take a slightly softer step. That is something we can discuss when we get to those discussion items. The other one which is still being discussed through the regulatory frameworks is the three waters levies. We've put that in here to give a full cost indication of what the regulatory impacts we believe are coming through. So those levies have been indicated there. The other one that's come through to us in relation to regulatory changes, however this is not impacting three waters, is the change in relation to remuneration authority giving us an indication of what's changing on council and mayoralty salary positions. The reason we've stuck that in there is it is a change from a regulations point of view. It is not something that we've impacted on. So we do not have a say in relation to that. We have to absorb that from that perspective. So that's why we've highlighted. That puts us at a position with all of those changes, like I said before, unmitigated, of 14.76. The other component I would state, which I've highlighted immediately below that, is the regulatory is heading towards three waters being user pays. It's important to note that because when you then switch to that model, council will be assessed, and I can talk later about the capping of rates component, but the capping of rates will be applied across the non-water three waters component, because the three waters will be focused on user pays equation and therefore have to cover the cost of the service completely. So based on that, there are two rates sitting there, which is the 24.07, which is the three waters opening position, and the non-water, which is 9.82. That is the non-waters opening position. As I say, those are the non-mitigated ones. We will talk to you about the mitigation measures in relation to those as we go through the slides today. Before we pause, because Patricia's going to give the details, Chair, I wonder if you want to do them on each of the detailed slides rather than through this slide.
No, sorry, say that again, Michael, I never quite caught it.
So Patricia's going to go through the details of each one, and I wonder if it's better to have the discussion on each one, and then we have the discussion after that in the public excluded component.
Yeah, I think what we should do though, just before we move on, are there any questions of clarification about that table? So we won't sort of debate the rights or wrongs of it, just clarification, thank you. Oh, the clerk.
Yeah, thank you, Tom. Just two things. One was from the previous overhead, which I couldn't get a question into. Staff advised us that the local government cost index from Burl was somewhere between 3 and 4%. And then they went on to suggest that insurance for councils, especially public liability, had moved up. But surely Burl must be capturing that if they're doing cost index that's specific to council. So that's one question I'd like them to answer. And the other question was just to clarify how much the insurance costs have gone up. I think I heard Patricia say $1 million extra.
Okay, in relation to the local government cost index, that will look across all councils. We had the position, Invercargill was the position that our insurer refused to extend cover to us in last year, so we saw a large increase last year where many other councils had seen that happen in the previous 10 years. So there was a number of predominantly medium to small who were with this on the same insurance policy where the insurer pulled out of the market. So it was an isolated aspect. And I'm just looking at Jamie for the increase, and I was thinking it was a $1.2 million increase that we had in insurance for the last financial year.
So is that the difference between what you're forecasting for next year and what we actually budgeted for this current year? 1.2.
Yes.
Okay. One other quick clarification. As part of the overall pitch on the last 2 or 3 slides, there's been some suggestion that the long-term plan has committed us going forward. And to change that to reduce costs to ratepayers would require an amendment to a long-term plan. So, and it would include or would incur some additional audit costs. So I just want to clarify 2 things because people from the public will be listening in on this. So redoing a long-term plan doesn't actually have a fiscal cost to us, does it? Because the staff are paid 52 weeks of the year, so regardless of what work they actually do. So that's point 1. And point 2, how much would it actually cost to re-audit an amended long-term plan? Would it be 100,000, 200,000?
So on the audit fee, I'm just looking at Rhiannon to remind me what it was, 200?
Our audit fee
Was
for the last
160.
LTP was 165,000.
I would expect
Yep.
that they would probably charge us around 180 for an amended, given that the fees are going up this year.
So I just wanted to clarify that. If we were to change our cost to the ratepayers by 4 or 5 million, and that would require some, in our annual plan, would require us to amend our long-term plan. If we saved $4 or $5 million, the cost could be 180,000 by way of audit fees.
We would
So-
only trigger, just to clarify that, we would only trigger an amended LTP if there was a significant change to the levels of service. So that would have to be assessed depending on what the cuts were, whether that resulted in a significant change to the levels of service agreed.
But worst scenario is that if we said to our community, look, I'm sorry, we can't afford 14.7, we can't afford 7.7. If the community is giving us that message, we would have to look at what services or how we provide those services. I mean, there's no other way of describing that.
So we're probably
So
getting
that-
to solutions.
Yep.
Not-
Okay,
I would
thank you.
rather not do that until the next grant.
Yeah, thanks, Chair. Just to clarify, and you may be going to do it, but the 24% on Three Waters increases, how, can you give me some context to that, please?
Through yourself, Chair, we'll highlight that later on in the slides, but the ring fencing component that you see up there is the big chunk of it.
Yeah.
That's the regulatory requirements. It's, in essence, all of the costs associated with that. There's nothing from the baseline outside of those components that's really adding to that aspect. So it is about meeting the regulatory requirements to add on to the LTP that give you that change. The other aspect is then splitting the two rates out, making sure that it is 100% user pays.
Yeah.
So we've had to go through and make sure it's full cost recovery in relation to that as a service itself, which hasn't been the case. As a council, you could have offsets in relation to services previously. Now this will have to be 100% user pays.
Yeah, so how have you come to that rates increase? So you've used you've sort of ring fenced what we charge for Three Waters rates now, and then you've applied the costs you've just outlined, and then that's how you've got to the 24.
So it's working backwards. So working out what the total cost is to deliver Three Waters,
Yeah, ring
and that
fenced.
ring fenced.
Yeah.
That is the amount of rates that we need to collect.
Yeah,
So that gets the number, the difference between and because they're all targeted rates, it's somewhat easier.
Yep.
And what we had in that long-term plan for year 2 versus what we need now,
Right.
that gives you your rates
yeah,
increase.
thank you. That's what I wanted to understand. Thank you.
So, quick question from me, and then I'll take you, Rangi. A quick question from me. This is the starting position. So I took this as being, here is the implication of what we have at the moment in the long-term plan and some things that changed, right? That's the starting position. But the two largest things on that list are things which seem to be discretionary. They've been, so in other words, the LTP year 2 smoothing is in the long-term plan. I don't know why it's been taken out of it. It's in the long-term plan, so I'm not sure why that 2.43 is there. And the change in towards 100% depreciation, 1.78%, we agreed in the long-term plan that it would be a certain rate. This proposes to change it. So I guess my question is this actually the starting position, or is this a position which management is advocating? Because those 2 points I've just made, between them 4.1%, make a very material difference to the overall total.
Through yourself, Chair, I'll take that on and answer that. It's not the position staff are advocating, because this, as I highlighted before, is the unmitigated. However, we do need the reconfirmation in relation to the financial strategy of the smoothing, and that's why it's been included. So it's just confirming it, making sure council is on track in relation to that smoothing, to give the council but also the public a very clear picture of what that increase was in year 2. So then we say, no, we're committed to that strategy, we're going forward. The other one that you highlighted in relation to the depreciation, it's put in there, that is a staff suggestion in relation to Three Waters based on the regulatory requirements. You either do it now as a 1.78, or we will be forced to do it in relation to regulatory compliance in 2 years' time. In 2 years' time, it will not be 1.78, it'll be double that. But it'll be even more than that when you look at it from just Three Water Services. So at the moment, that is over the council giving you that position, but then split into Three Waters. It's one of the biggest increases in the Three Waters aspect. If you delay it, it will be even larger. I would highlight now that if you did the whole, you would be looking at a Three Waters increase close to 30%.
We're not actually delaying it, though, it's actually bringing it forward.
Yep.
Yeah. And the LTPs not included. Rangi.
Correct.
Thanks, Chair. Look, to help councillors come to grips with what the staff have put up there, the local government website has a very compelling document that was released March last year, prepared by Invercargill, Brad Olsen, and the picture it paints is actually worse than what we're seeing. We're lucky we're not a district council. The bridges are up 38%. Yeah, that's scary. So this cumulative effect that the CE was talking about, that if you don't act, is very well spelt out in this document. So that's Infometrics, and I recommend councillors read it, if not now, in their lunch break, whatever, because it's prepared by LG&Z and it's right on the money for exactly what Patricia and Michael are talking about.
Okay. Okay, keep going, Patricia.
Okay, so just to work through each of those components, so rate smoothing. That graph that we include on the slide there, the green is the total council rates and how much of that is water. So really what we saw when we did the LTP raw was that the first year was double digits, as was the second year. And what we did, well, what rate smoothing does is it takes, and in this case it took over 2% out of 25, 26 and moved it out into 27 and 28. It's how we get that nice, we stop what could potentially happen is each 3 years, the rates numbers going up and down. So it gives a bit of consistency. But what that actually really meant was that we were going to be running operational deficits because we weren't actually collecting enough rates income, but by the time we get to year 4, we do. So that's what we were meaning by rate smoothing. We acknowledged in the LTP that we had an unbalanced budget and would for the first 3 years, and that's what it shows.
So before you move on, no questions, so I'll ask one. So we consciously decided during the LTP that we would smooth because it was to the benefit of ratepayers to not face, ginormous increases in 1 year and very, very small increases in 3 years' time. Better to smooth it. So that decision was a conscious decision. So can you just explain why it's proposed that we go back on that decision now?
It's not proposed that we go back on that decision. We need to reconfirm that we want to keep rates smoothing in. It's more to give the full picture that actually the increases are much larger and that the fact that we had the smoothing in there. So that 8.5 that we agreed was really 10. We've pushed 2% out. So that was just to build it back up, and so what we're taking you through today is allowing you to see how it's got high, and then how we can bring it back and mitigate it.
Okay, thank you. I've got a question from Leslie, but do you want to clarify what Patricia's just said?
Yes, please. Thank you, Chair. I just want to highlight, and I'm happy to state this in the public record because it will be discussed in PE, but in relation to the rate smoothing, staff will be recommending to put the rate smoothing back in. It is one of the items that we would support from that perspective. So we're not suggesting, we're just giving the vision to everyone what the worst case scenario is without mitigation, and we will highlight the mitigation measures, but that will be one that we will be quite strong on recommending.
Okay. I mean, it's something that every business does, actually. Leslie?
Thanks, Mr. Chair. Look, it's not a question. It's just saying on this particular rate smoothing issue, it's really important that it is here very openly, because the other part of that conscious decision was to run an unbalanced budget and therefore fund some of our operational expenditure by debt. So that was another part of the conscious decision we made for ratepayer benefit, and it is absolutely essential that it's on the table if we're going to reconfirm it, that it's clear what we're reconfirming is that we consciously go for 3 years of an unbalanced budget, knowing that we have to bring it back into balance, and that we are therefore funding some expenditure by debt. We can't miss having that openly there for reconfirmation.
Okay, thank you. Graham?
Yeah, thanks, Chair. So the rates smoothing was 3 years?
It was probably done over the first 3 years is where we focused it on.
Okay, yeah. I did have another question, but it's gone from my mind.
And if you recall, the reason why the rates are high in those first 3 years is that we're trying to get the rates funding of depreciation up across council assets.
Yeah, sorry.
From very low to, I think we were taking slightly longer to get water than what the Act will require us, but yeah, that was the reason for the increase.
Yeah, so that was my question. So if you go back to the previous slide that Michael ran through, so the 8.5% increase includes the lifting to 94% of depreciation funding, is that correct? Is that what that says?
It was 87 for Three Waters,
Yeah.
and we had raised a lot of the normal council classes, so we were raising property was coming up, I think was the other major class of assets that was coming up at the same time.
But I think you've proposed to lift it to 94%.
We did further down,
Yeah.
In the lower part.
yeah, in the lower part,
Oh,
and that
Supporting
added another
Right,
1.78.
Yeah, no, thank you.
So we should keep oh, sorry. Yeah, Evelyn?
Just given that some of what we're looking at is unanticipated external effects that we cannot control, but it occurs to me, while you've indicated that our insurance has become more expensive, bearing in mind what is going on in places far remote from here but does affect the insurance industry, are we potentially facing a higher than predicted cost for insurance?
I'll get onto that in the next slide.
Oh, sorry, I didn't want to bring
You're just jumping ahead there, Evelyn.
The conversation
Yeah.
just triggered the thought in my mind that we're all happily sitting down here and thinking, well, none of this affects us, but perhaps it does.
Okay, done. Oh, no? No? Okay. So, next slide.
I think we've probably covered this one actually. This shows the two graphs that we had. This is the LTP versus in blue versus what we're seeing now, which shows that we're going to get to where by the end of the LTP, it'll get back to where it is, normally does over a 10-year. But that just shows the impact of that increased inflation over waters and non-waters. So as you'll see as we go through these slides, we've done the rates impact to water users, non-water users, and then total over ICC. Ring fencing adds a level of complication. Insurance, we have options with
Oh,
insurance.
sorry, you've changed pages. Any
Oh,
questions on that one from anybody? Okay, just one quickly from me. Inflation is a index which has been changing pretty fast in the last little while. And obviously you are using as latest the November 2024 update. Do we have any data for, you know, where we are now? I know it's only 2 months further on, but has it significantly fallen? Do we know?
The local government cost index is only reviewed annually or twice a year. They tend to do an interim about July and then they finalise it in October. Because they never used to. It used to come out about August, September, and that's what you went with, but it's been moving so quickly they do it twice now. These will have stayed pretty similar, but it is, as we said, as soon as you use a number, it was likely to change. So it is a forecast, and they're forecast inflation, so it's the best information that we've got to hand.
Okay, and are we obliged to use the November forecast number?
We are not obliged. We could create our own indice.
I'm
But
not
given-
proposing that we should, I'm just asking if
Yeah.
we're obliged, because it's just for clarification.
We have economists that provide with us with a number. I'm not an economist. I don't really want to have to go out and purchase my own inflation number. So it is probably one of the best, it's the best that we could do. We could add a margin or we could take it off, but I wouldn't recommend it.
I mean, it's against the background of declining inflation. That's the point I'm making, isn't it? It's not flat. Inflation, it's actually declining at the moment.
And they are now showing that it's declining, but just not as quickly as what they first thought.
Okay. Did I have another question on that page? No? Okay, keep going.
Okay, insurance. Well, we've said the insurance has increased, and this pulls up the impact of having to get new liability cover last year. We have got options available to us, and there's a paper that I will be bringing to Risk and Assurance, the next Risk and Assurance meeting, about how we could make some changes and how we take our insurance cover out for the organisation, which would have that could potentially reduce the premium. What Evelyn had mentioned earlier about what we're seeing in the global, I have also asked the brokers about that. If we were in a bushfire or area, we would probably be, there's the potential that we would see premiums go up. Southland and Invercargill is not considered to be high risk from bushfires, so we should see a flattening. What they're seeing globally is a relative flattening in insurance premiums coming into this year, so fingers crossed that would continue on. But it's how much risk as a council we are prepared to take on. Insurance premiums are all about risk, and how much risk, if we were to take on more risk, we could drop the premiums. And those are some of the options that will come through to Risk and Assurance in a fortnight's time.
Questions? No? Okay. Yeah, Rangi.
Thanks, Chair. Look, just confirming this, and I should know it, but the insurance of, say, our Three Waters, the state of the network, as in the age of our Three Waters system, has no impact on insurance against. We can't claim insurance against failure of an old thing. It can only be external factors like an earthquake or a failure like that.
So our underground pipe network is essentially only currently insured for natural disasters.
Right, but you don't normally insure it for failure due to age or anything like that.
No, in the insurance market, nothing is impossible. You just pay for it.
No, but we only.
I would suggest that paying for the failure of that would be astronaut. Yes.
No. Just because someone's household insurance, they don't know how old their pipes are sometimes, and there's a leak, and you get insurance. But when it comes to council, no.
There's one aspect in insurance, sorry, Chair, that I've just realised, is the fens levy. within, and as you will have seen on your homes one, the fens levy is a very significant part that we pay as part of our insurance on our buildings. So as part of your building premium, the fens, so it's effectively the government has required the insurers to collect a levy off all building. There's legislation around it, but for us that's a significant, I think it's $300,000 or $400,000 of that insurance premium essentially goes through to the government to fund fens.
Did that siren remind you of that?
Time.
Alex, have you got a question?
Just a quick question. Does it include our governance indemnity insurance?
I'm sorry, Alex, I couldn't hear you. Say that again.
Does it cover our governance indemnity insurance for?
Our indemnity is included in that.
Yep.
I'll make a bad decision.
Okay, next page.
Just a quick.
We're not cutting that.
Okay, so this is one of the smaller increases, and it just reflects the additional debt, interest and repayments that we've got principally from the changes in the capital program, but really it comes from having the large operating deficit that came through from 23-24 coming through. And as I said earlier, the borrowing interest rate assumption is going to remain at 4.5. That's still appropriate given the latest changes, subject to anything that might happen next month. So
Okay.
that's all
Keep
I've got
going.
on
I
that
don't
one.
see any questions.
Now we get into the regulatory type ones. So as we've been discussing, as three councils discussed with the proposals, Three Waters becomes self-regulating essentially, as the Three Waters operations will pay for the regulations from Te Mata Arawhai and the Commerce Commission. Those current estimates is that will total over 300,000, and that will commence in 1 July 2025. So we have to put a number into the budget. Some of these ones we can't really change, and that's the rates impact.
When we were, through you, Chair, when we were discussing that the other day, it was the, and to Leslie's point, asterisks that we were only being levied for a particular portion of these services to begin with. Do we have any idea what that projected, what that could be if it escalates for the rest of the services?
No.
Just no.
No, not yet,
No-
because it's so,
No further indication from
no further
last week?
indication.
Oh, okay.
It seems an extraordinarily high amount actually to me, but anyway, questions of clarification, I guess, at this stage. Okay, next slide.
So this reflects at the moment what the indications that have come from the Remuneration Authority in relation to councillor salary increases. I do believe we're still waiting for the mayoral one, but the indication at the moment it's approximately 20%. So we are factoring that in. We are allocating that to the non-waters activities.
Yes, Evan.
Is this a consequence of the survey that they did last year about workloads and things like that? Because, I mean, the increases over recent years have been more based on cost of living type situations. Is this a workload sort of a situation that's making such a big spike?
Through yourself, Chair, yes, that is the case. It's based, initial information that's coming from the Remuneration Authority is that it's based on the increased workload associated to the councillors and highlighted in relation to the regulatory changes, etc., that are coming through. So that's what's been indicated in this.
Okay,
So
Randy.
can I follow up to
Oh,
that,
yes,
please?
yes.
Mr. Chair, I think that for me, public needs to understand that some of this is not driven by us. It's driven by outside demands, including central government, because a lot of what it seems to me in the 3 years that I've been sitting here, that we're responding to is things that we have to do, not that we want to do, and that some of the regulation, particularly over the last year, and the speed of change has actually been quite onerous on councillors. I'm not defending, you know, it would be lovely if we could all afford to work for nothing, but that's not, we still have to pay the electric and the rates. I just wonder how we're feeding back to central government though, given that they're sending clear messages about we need to live within our means and all those sorts of things, that they're actually unhelpful. Because I don't think that anybody here should not be paid what they're worth, staff and councillors and anybody else, but I think that when we're responding to forces over which we have no control, and particularly, you know, having meetings about changes that happened in the middle of the night 3 days ago, it makes it really difficult, and yet the public doesn't see that and expect us to actually make the money stretch further, because their money has to stretch further. So getting this message out publicly to the point that Councillor Pottinger made, and we've, you know, about going into public excluded, sometimes we need to actually say these things out loud in public in words that a layperson can understand. We didn't choose this. This is what we're getting served.
Well, I think that's a point of clarification, which is fine to be out in public, Evelyn. I mean, I don't have a problem with that. Rangi, do you have a question?
Yeah, like, I'd just like to comment about this. It was actually a question, not a comment. Is this a recommendation to our council by central government, or is it an obligation we have to fulfil?
Through yourself, Chair, it will become an obligation when it is sent through as the official letter, but it will be an obligation.
Just the reason for clarification is a lot of the things we've seen in the list, we do have the ability to change. This one we don't.
We can't change this one.
That's okay. I mean, we can.
I mean, it will not affect this council, of course. It will be the next council that will affect, because this would take effect after the election, wouldn't it?
No.
No? So when would it take effect?
I think it will
1
be,
July.
I think it'll be 1 July.
Oh, really? Okay. Leslie.
Thanks, Mr. Chair. This may be a time when we're talking about government regulation, which we have no control over, just to ask the question of Patricia and the CE. Another thing that we do not have control over is the fact that government departments do not pay rates. Is that the case?
Correct. They do not pay rates.
Right. So there is a very large component of invoice that we could be sending to the government, stating that this is the rates component for the properties you own, occupy in the Invercargill City Council rating area. But in fact, that large component is by regulation not paid by the government. So just so that it's out in the public, central government is putting a great deal of additional onus on us, but is not contributing an ordinary rates payment to us.
So they will pay for their waters that they receive. So they're targeted rates, so the services they receive. So they pay for their rubbish and their water, but they do not pay for any of the other services that council provide, that we would pay for under the general rate.
Thank you. Just an important component I think needs to be out there in the public, so that the public are quite clear on that particular aspect.
Okay, but I mean, I guess the summary of that discussion is that there is no one in this room who has got any control over that additional payment to councillors or to the mayor. It's a matter that's decided centrally and takes into account things like the need, in government's view, to attract a particularly qualified councillors, people who stand for council, to attract younger councillors and so forth, who simply cannot afford to give up their job. I mean, these are the sorts of things that weigh into that, but there's nobody here that's got any influence on that. We cannot say we don't want it, we're obliged to take it. Okay. Nobby, you've got a question?
Yeah, no, just more of a reflection on the monitoring costs of Three Waters that are coming by way of the Commerce Commission and the regulator. It seems a real overkill that we have to put in an annual water services plan to DIA, who monitor not only what we're doing going forward 12 months, but also will have some reflection of what we've done in the previous 12 months against the previous plan. So over and above that, we're going to be paying about 300,000 for those two authorities, the Commerce Commission and the regulator, to look at us as well. User pay, recover the costs, as it were. Quick calculation: if we're an average sized council, and there's somewhere between 53 and 67 councils in the country, those two government agencies are probably pulling in somewhere between 18 and 20 million dollars of councils nationally. So that employs an awful lot of staff, I would have thought, to be doing what is fairly minimum sort of task. And I just think collectively, and certainly local government, New Zealand, which is our lobby group, should be pushing back on those costs.
Okay, next slide. Patricia.
Okay, so,
Back to you.
sorry, it's back to me. Just going to go through the items on the next 3 slides, and then they can be discussed line by line, Chair, as you want to, in the next section of the meeting. So the first slide are the adjustments that the leadership team are recommending that you do need to make for the activities to continue. So I'll just go through them briefly. The first one is budget for sister city events and relationship. There's currently no budget, so to allow that to continue, there is that increase. Same thing for the councillor induction. Obviously the election is in October and bringing the new council on board. Increased legal support and advice within the business. Those costs are increasing. There's a change on the library system fees that have gone up, so those will need to be covered for the service to continue. There's some adjustments that can be made of removal on operations costs for property that has been sold over the last financial year. And also the NZTA approved program, that adjustment can be made in terms of that flow through that's come through from NZTA. There are minor movements across all the budgets that are under $10,000 that are just included in one line. A big one is that we are also going to need to increase the amount going to the QV contract, so that's the revaluation contract for property, which is required to be done. And then the final line is a depreciation funding adjustment, and that's simply due to shifts and small movements within the capital program, so it doesn't relate to the later depreciation items. Should I keep going?
No, we'll take questions on that, and again, it's just questions of clarification. So, one from me, councillor induction. It seemed to me actually there's a few in that list, but I'll particularly talk about councillor induction. I mean, we've known about this election for, I don't know, 100 years maybe. Are we saying that there is no money in the existing plan for councillor induction?
Do you want to take that one?
I'll take that, Chair. Yes, I have to openly say that that is not currently sitting in there. And it's got to do with the fact we split out our governance budgets in the last long-term plan, and these are two highlighted areas in relation to our budgets, which is the sister city relationships component and also the council induction. We will talk about those later in relation to what staff's recommendation is, but
just to answer that specific question, are you saying that there is nothing for councillor induction in our current plan?
that is correct.
Okay, thank you. Okay, next, sorry, any other questions on that page? Okay, next page.
Okay, so the next 2 slides deal with items really for your decision. The first one relates to asset planning. We've discussed quite many times over the preparation of the long-term plan, the work that we need to do to improve our asset condition assessments. So that's a recommendation from the team in the waters area that's required for the water program. There's the item that I think came through the mayoral forum for hosting of civic events, including Civic Honours, Anzac Day and Waitangi Day. There is no budget for those, so that's being recommended to be considered. And then increased contract costs for the running of the public toilets, so that's the maintenance and the cleaning costs, that those contractor costs are coming in higher and need to be covered to maintain the level of service. There's increased costs within the recycling service, within the waste activity. There are also utility cost savings which we can flow through into the budget. That's the electricity coming in lower. The next one, which is the capital for the Boxall retaining walls, that relates to Boxall Street or Boxall Road. I'm not sure whether it's a street or a road, but it relates to a risk to that road because of an Environment Southland owned asset which is degrading, so that work needs to be covered if that road is to be protected. There's the option to bring lighting onto the exterior of the Civic Theatre that's in the following financial year, and capital investment for the Wharapuni at Anderson Park to maintain that asset.
Okay, so any questions from, yes, Rangi?
Look, I saw the recycling services cost there, but we've got a waste net meeting, I think, later on this year, early next month. The green bin thing, now, we're not factoring in that extra bin, are we? No? No other bin changes, it's just a cost in providing that service, the increase. No, that's okay, I'm just making sure that, looking at Dunedin, who've now got 4 bins, they're running out of footpath space, but we're just sticking with 2. Yeah, cool.
I think it's a separate point actually, but I think it's important to remember, and I should have said at the beginning, that we are talking about the annual plan for 25-26. This is not a change to the whole LTP. So when we look at things like Sister City, we're asking ourselves the question whether we want to spend anything in this coming financial year. We're not talking about the next 8 or 9 years. So it's easy actually to think, actually, if we make a change, that's a permanent change. It can be a 1-year change depending on the circumstances. Okay, so the intention now is to move into public excluded. I don't think I need a motion for that, do you, when it's a workshop? No. So we will move into public excluded, and thank you very much, everyone, for joining us. I have no doubt everyone will wait for bated breath, with bated breath for the outcome of the whole thing. But anyway, thank you for joining us. Cheers.